Stocks. Stocks mean you own a tiny piece of a company, even if it's just enough to say technically, I own this. When a company does well, your investment grows. When it doesn't, your mood probably doesn't either. Prices move up and down constantly, sometimes for clear reasons, and sometimes for reasons nobody fully understands. Bonds. Bonds are like lending money to a government or company and expecting them to pay you back with interest. It's the calmer, more predictable cousin of stocks. You won't see dramatic highs, but you're also less likely to have dramatic heartbreak. Mutual funds. Mutual funds are what happen when a bunch of people pool their money and let a professional handle the decisions. It's like hiring a chef instead of cooking yourself. You might not know exactly what's happening in the kitchen, but ideally, the result is something solid and reliable. Exchange-traded funds. Exchange-traded funds, or ETFs, are similar to mutual funds but behave more like stocks. You can buy and sell them anytime the market is open. They usually follow an index, so instead of trying to beat the market, they just go along with it, like someone calmly walking through chaos. Real estate. Real estate is about buying property and hoping it becomes more valuable over time. You can also earn rent while holding it. It's one of the oldest investments, and unlike stocks, you can actually stand on it, paint it, or complain about maintenance costs. Gold. Gold has been valuable for thousands of years, long before stock markets even existed. People turn to it when things feel uncertain. It doesn't produce income, but it has a way of quietly holding its ground while everything else is panicking. Cryptocurrency. Cryptocurrency is digital money that isn't controlled by any government. It runs on technology that sounds complicated and often is. Prices can rise quickly and fall even faster, so it's an investment that can feel exciting one moment and confusing the next. Fixed deposits. Fixed deposits are simple. You give your money to a bank, they promise a fixed return, and you wait. No surprises, no sudden drops, just patience. It's not thrilling, but it's dependable, which is exactly the point. Public Provident Fund. Public Provident Fund, or PPF, is a long-term savings option backed by the government. It encourages you to save regularly and rewards you with steady interest and tax benefits. It's less about quick gains and more about quietly building something over time. National Pension System. National Pension System, or NPS, is designed to help you prepare for retirement. Your money is invested in a mix of assets, and over time it grows into a retirement fund. It's basically your future self asking you to be responsible today. Commodities. Commodities include things like oil, wheat, and metals. Instead of buying the physical items, investors usually trade them through markets. Prices depend on global demand, which means something happening far away can suddenly affect your investment. Derivatives. Derivatives are contracts based on the value of other assets. They can be used to manage risk or to try to profit from price changes. They sound simple at first, but they can get complicated quickly, which is why they're often approached with caution. Savings accounts. Savings accounts are the most basic place to keep your money. You earn a small amount of interest while still being able to access your funds anytime. It's not designed to grow wealth quickly, but it's perfect for keeping money safe and available. Peer-to-peer lending. Peer-to-peer lending lets you lend money directly to others through online platforms. In return, you earn interest. It can offer better returns than traditional options, but also comes with the risk that the borrower might not pay back. Index funds. Index funds are built to follow a specific market index instead of trying to outperform it. They keep things simple and low cost, making them popular for long-term investors. It's like deciding to move with the crowd instead of trying to outsmart it.